So guys, first of all, I would like to start to addressing some things here. That is what actually happened at me all. So I need to have this one here in the chat on the other side, so then I can look at everyone. Okay, so we had the FOMC this morning. It was 4 a.m. to us in Australia. And then we had as well some PMI that we're going to touch on that. We're going to have the NFP tomorrow. Luckily, now it's, the daylight savings ended. So it's much earlier than it was supposed to be before. I think before it was midnight or something. Now it's 10:30, so pretty happy with that. And then we're going to go to Saturday, and next week I'm pretty sure we're going to have lots and lots of volatility. So that's usually what it happens on NFP days. We have a short period of time during the release and the close of the market. And then on the opening on Monday, some of you maybe on Sunday night, it gets pretty volatile the whole week. Just observing what was the actual release of the data on the last Friday. Okay. So first of all, let's go to the economic calendar here on yesterday. So everyone knows was most of the world was on holiday. Italy, France, Spain, China, UK, Germany, Brazil, India, and some other countries was some of them were Labor Day, some of them were another thing. But this is pretty much it for yesterday. So we had the ADP non-farm employment change. They came in higher than expected. And as well, it was revised up the previous. So it was revised up to 208,000. All right, 208,000. The forecast for the month of April was 179,000. And it came in at 192,000. So pretty much a little bit over than expected. Okay. And then we had 11:45. I remember that manufacturing PMI for US came higher than expected, but it was 0.1 higher than expected. So basically, very, very small change in there. Okay, we had from previous 51.9, and then they forecasted a 49.9, and then the actual came in at 50. So it was very small. Okay, when we look from the previous to the actual, so the previous month, that was March, to the April, that was a big decline. Okay, when we look to 51.9 to 50, so we had a 1.9 points decline. So that's pretty big for PMI. But in talking about actual and forecast, that's very, very little. The market didn't even felt that. Okay. So today we started the day midnight, of course, with the ISM manufacturing employment on 48.6. Okay, the forecast was 48.2 and the previous was 47.4. So that was a better than expected from the previous and from the forecast. All right, so that was pretty good. So 48.6 is pretty much 1.2 higher than the previous, but only 0.4 higher than the forecast, but still higher. So that was pretty good. After that, we had the manufacturing PMI. But remember, okay, so yesterday we did have, of course, here the manufacturing PMI, but that was from the S&P Global US. Okay, so a different data release. And then today we did have as well, but from the ISM. All right. That was 49.2. So previous was 50.3, forecast was 50, and the actual came in at 49.2. So that's not good. That came in lower than the previous, lower than the forecast. So it had a negative impact on the US dollar. Okay. And then we had ISM manufacturing prices for April as well. That was much, much higher than expected. So we did had the previous of 55.8. We had the forecast of 55.5. So that was, forecasting a lower than the previous. But then the actual came in at 60.9, nearly 61. Okay. Is it good? Well, for the currency, of course, is good, but for the economy, it's not. Okay, it's simply not good for the economy. Why? So the ISM manufacturing prices basically shows to us how much inflation there is on the manufacturing side of the economy and how those inflation is affecting the prices for those business owners to manufacture something. All right, let's say a pen. Okay, that's the first thing I had on my hands. It's going to be this. That's going to be the example. So now it's more expensive for me. Oops, sorry. It's more expensive for me to manufacture a pen than it was on the month of March. Okay, so what does that mean? Does anyone know? Put your answers on the chat. I'm gonna wait. It's a pretty simple answer. Nathan, you have an answer, Nathan? No? Okay. So it basically means that I will have to charge more because of the inflation. Consumer have to pay more. Exactly. So the end consumer will have to pay more. I don't want to take this inflation to me, right? So I'm sort of passing on. You know what I mean? Like if it's costing me $1, I want to have at least 75% profit on that. I'm going to charge $1.75. So that 75 cents will be my profit on top of the $1. And therefore, that's why, used to cost me 80 cents. Now it's costing $1. So 20 cents of inflation. Okay. And then, of course, I will, I will put this into the end of the, there is a technical name, but I just forgot the technical name now. The end of the pipeline, something like this. So it will be basically for the consumer to pay. Okay, this is reasonable, right? It's pretty reasonable. Because consumers can pay, okay? And this is the problem. And this is where the problem is. Because if inflation continues to exist, it will always exist above what is actually proposed by the central bank, the Fed, and the Federal Open Market Committee, that is the 7 members. So then what will happen? If people continue to spend because they have money, and I can prove you that, then they will be like, oh, okay, there is inflation, but it's not even that bad. I can continue to buy pens. I can continue to buy my car. I can continue to buy that, and this, and that. Oh, that's all right. Not a problem. That's the problem. Because what are the Fed trying to do? The Fed's trying to control the consumption. Therefore, the inflation will come down. So I'm sharing my screen, right? Yeah, I'm sharing my screen. So this is really bad. When we have higher spending, higher retail sales, higher people getting paid, more people getting employed, it's all good. Yeah, fantastically well done. But remember, the first concept that it makes inflation go lower is no spending, low expenditure on the balance sheet of the society. And this is not what is happening. Okay, we know this is not what is happening. Okay. And then and this just doesn't help. Okay, this just doesn't help. And then we had at 4 a.m. the FOMC statement, the Fed interest rates decision, and the 4:30 we had the press conference. Of course, guys. I mean, come on. I've mentioned that already last time. No one here has 13 years old. No one here is that dumb to believe that the Fed would cut the rates right now. Sorry if I offended you, but no, forget about it. Definitely they won't cut the rates right now. Okay. So 5:50 is on Tuesday. US dollar employment cost index news make a significant impact. What does that mean? We will get back to that, Santi. Let me just finish this. Good question. Good question. So the Fed interest rates decision came in as expected, 5.5. No changes on the forecast, nothing. Okay. So let's go to Santi question. Tuesday. On Tuesday, USA employment cost index make a significant impact. Sorry, mate. You mean this Tuesday or next Tuesday? Because there's no employment cost. Tuesday. Well, it's not in here. Oh, there we go. Employment cost index, 1.2%. Sorry. It does affect as well. Okay. So, but it's nothing that I look too much. Why? Because it's a quarter over quarter. I'm not looking into the monthly data. Okay. Like initial jobless claims we have every week. Okay. We have every week. So this is why it doesn't have a Brutus. It doesn't have much. It doesn't have a huge impact towards the market. Of course, it does have an impact, but it doesn't have like same as an NFP, right? That it's only monthly reported, or sorry, or a CPI that's monthly reported, or let's say a employment change or something like that. So pay attention on those ones, but I'm going to explain to you how does the employment cost index this affect. It is good because people get paid more. Okay, this is fantastically, but it's exactly the problem. In this situation, this news is looked as negatively. Okay, why? Simply because we have the people spending more money. Okay, and if they're spending more money, then this will just make the inflation higher and higher. Okay, hope I helped. Right, so let's move on. So today, okay. Today we did had the Eurozone manufacturing PMI and Germany manufacturing PMI, France manufacturing PMI, and Italy manufacturing PMI. Okay. Let's take as overall good because we had 45.7, 42.5, 45.3, and then just Italy not too good. Okay. Then today we're going to have non-farm productivity. We're going to have initial jobless claims, as we all do every week. Continuous jobless claim, exports and imports, very important. Okay, pay attention on that. Trade balance for Canada. Bank of Canada Governor Macklin will do a speech. And then tomorrow, that is on Friday, we have a holiday on China and Japan. Okay. And most importantly is the non-farmer payroll. And we're going to have Lane doing his speech as well. Okay, so that's UK composite PMI, UK services PMI as well, very important. Unemployment rate for Europe, average hourly earnings month over month. That's most important. See how the year over year and the month over month doesn't have the same sort of priority. Okay, the impact. Non-farm payrolls, of course, unemployment rate, very good, and S&P services PMI. Right. Do you guys have any questions on the economic calendar, or can I move forward? No questions. If you have questions, you're more than welcome to ask. Okay. So everyone is good. Let's move on. Well, they're talking to me in the office. What's happening? Yeah, yeah. Okay, let's move on for the Fed. Okay. Okay, so if you guys want to have this link, I can send the link to you so you can have Fed website. There you go. Fed website is there. April, you can click on the HTML. So if anyone wants to follow with me, you're more than welcome. Okay, let's go. Let's start with yellow. Okay. There you go. All right. Recent indicators. Okay, guys. So just a very brief introduction here. This is the Federal Reserve website. It's an official website from the federal government. This is the you can access through here. All right. So that's the April statement, and then we're gonna get through these together. Right. So first of all, recent indicators suggest that economic activity has continued to expand at a solid pace. Yes, yes, and yes, this is true. Okay, this is very true because recent indicators have showed to us that the actual economic activity has continued to expand at a solid pace. This is true. Job gains have remained strong. This is also true because the last month NFP did have a higher than expected. Okay, so job gains have remained strong. Perfect. The unemployment rate has remained low. This is good. Inflation has eased over the past year, but remains elevated. In recent months, there has been a lack of further progress towards the committee's 2% inflation objective. So, okay, let's stop there and have a look into this thing here. There has been further, and here, actually, let me put this in black. Okay, so there has been a lack of further progress towards the committee's 2% inflation objective. So what does that mean by that? Well, if I think you guys probably know that, but the Fed, any other central bank, have a 2%. Well, it can vary. All right, it can be 2%. Sometimes it can be 1 to 2%. Sometimes it can be, fluctuated depending on the market. So it's very different. All right. So the Fed has a 2% inflation objective, and right now they are at 2.5%. So that's higher, 0.5 higher than what actually what are they expecting? All right. So they haven't put down inflation. Inflation continued to go up and not down. And they've stated these on last year that inflation would be sticky, unemployment would be high, and this wouldn't, it wouldn't make good match with the actual economy. Okay.
So with this first phrase here, this first thing here, we can have a very good overall look into US economy, right? This recent indicator is suggesting that economic activity is continuing to expand on a solid pace. The jobs have remained strong. Unemployment rate has remained low. Inflation has eased the over past year, but it remains a little bit elevated. And the only bad thing here out of 5 things is that they haven't yet controlled the inflation to get to the 2%. Okay, so that's the only bad thing. So 4 against 1, still good. Let's go for the second line here. Sorry, second paragraph here. So the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. So what does they mean by that? Oopsie, that's too tiny. So the committee seeks to achieve maximum employment. Okay, so they want to continue to have the maximum capacity of employment, and at the same time, they want to reduce the inflation. Okay, so they want to do these 2 things. All right, this is the dual mandate. All right, so they have 2 mandates. That's the dual mandate. What are they? Reduce inflation to 2% target. Don't get it wrong. I know it's only 0.5%, but this is the exactly point that it gets tricky, because lower the number is, it's higher to put the number closer to the percentage target. Okay, so that's economic classes. Sorry, I have to remember. So that's the first thing. Okay, so when it's 8%, when it's 12%, coming down to 10, coming down to 6, coming down to 7, 5, it's fine. It's sort of easy. Why? Because it's a big number and we know it's inflated. Soon as we put the rates up, population will stop spending for a second, and then we can put the inflation will come down by nature. Okay, now the rates are already felt into the economy. All right, population is continue to spend. Therefore, reducing these 0.5 is the same as reducing 10% into a 20%. So it's half. So it's a lot. All right, still a lot. And this is why they're so strict about this. We are committed to reducing inflation to 2% during a mandate. We want to have high employment while we reduce inflation to 2%. And they will say this every time of the FOMC of the Fed. Okay. The committee judges that the risks to achieving its employment and inflation goals have moved towards better balance over the past year. So that's good. All right. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. So that is not good. Okay. When we look to the economic outlook is uncertain, and the committee remains highly attentive to inflation risks, there is a possibility of inflation upticks. All right, let me drink a bit of water here. Oh, euro dollar is dumping. You guys seen that? Euro dollar is going down. We're gonna get there in a second. So, when they say that the economic outlook is uncertain, well, they're basically saying that they don't know if the economy will expand, if the economy will retrace. What are they looking for? They don't know. Okay, so if they don't know, imagine me, poor guy. I don't know as well. But I can guarantee to you that the committee is remain highly attentive to inflation risk, means there is a possibility to inflation come higher, okay, in the next coming months. So just be aware and be, attention with that. Now, third paragraph, and one of the most important. So this is where we have why the US dollar got weaker and not stronger, okay? Because until now, it's all positive for the US, isn't it? That's perfect. Okay. So in the support of its goals, that is, we just mentioned now, do a mandate. The committee decided to maintain the target range of the federal funds rate at 5 5.25 and 5.5. So 5.25 to 5.50. Okay, percent. In considering any adjustments to the target range for the federal funds rate, the committee, let me just highlight these, 5.25 and 5.5%. The committee will carefully assess incoming data. What does that mean? That they are data dependent. The involving outlook and the balance of risks. Okay, so in considering, let me change the color, any adjustment to the target range for the federal funds rate, the committee will carefully assess coming data, the involving outlook, and the balance of risks. So that basically means, let me grab it here. Oopsie, I want it black. Sorry. Data dependent. Okay. So pretty much this is what they mean, oopsie, sorry, by that. Second, let's go. So the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. Okay, stop there. So they say that the committee does not expect it will be appropriate to reduce the target range until it's gaining greater confidence that inflation is moving sustainably towards the 2%. So what does that mean? That they are not looking to cut the rates. They're not looking to cut the rates until they see that the inflation is coming down sustainably. So that means not as it's coming right now. The data, I want you guys to understand, what does that mean when they say that they want to see the inflation coming down sustainably? It doesn't mean that today it comes lower. Okay, next month they will cut. No. They want at least a quarter and a half of data, the actual data coming in on the market and seeing that inflation came from 2.5 to 2.4 to 2.3 to 2.2. Okay, this is what they want. All right, maybe not that aggressive, but like 2.5, 2.45, 2.4, 2.39, something around those lines. This is what they want. They want to see something that is actually coming down, not as we're having right now. 1 month it comes 2.4, other month it comes 2.8, and then comes 2.6, and then comes 2.2, and then comes 2.9. So you see, like, it's completely doesn't have an EQ point, doesn't have an equilibrium point on that. It's completely like this. They don't want this. They want a sustainable curve down. It can have a little uptick, it is fine. You know, continue to go down. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The well-known MBS, mortgage-backed securities. Beginning in June, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities from 60 billion to 25 billion. That is a big, big change, my friends. Okay, this is a big change from 60 to 25. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at 35 billion and will reinvest any principal payments in excess of this cap into Treasury securities. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee assessment will take into account a wide range of information, including, that's important, okay, so let's highlight that. The committee assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. All right, so this is what they are looking to discuss into the next meeting that it will be on June, if I'm not wrong. Okay, so this is where it will be what are they will looking. Okay, so let me write this here. Where is it? Oh, there we go. So data, we can write like data that the Fed/FOMC is looking for the next decision. Oopsie. There we go. Let me put this here. And let me take a screenshot of this. Just a second. So you guys can have it. Oh, what is not moving? Okay. So let's have a look on the. There we go. Okay, so I've took a screenshot. I'm gonna send this on the Telegram group. So if you guys need, it will be there. All right, let me just stop share my screen here and move the things now. Second, all right, I can talk with you like this now. What will the Fed do in its next meeting? There we go. Okay, so let me share my screen again. Okay, can you guys see it? Probably can, right? So there's some things here that I want to mention. Okay, there's some things I want to mention. I can't show it here, but I can mention that from the Fed. Okay, let me just take it my folder. So there was a few things that the Paul say, and he say that we will likely need to see wage growth slowing to more sustainable levels to achieve the inflation target. Okay, he stated as well that the confidence, saying that his confidence in inflation falling back is lower than before. Slower than before. Okay, basically the Fed, John Paul is saying that his confidence on the inflation falling is lower. So he has lower confidence now that inflation will come back down. Okay, that's he's saying. He always said, sorry, that his expectations is that we will see inflation fall back this year. Okay, so he was looking for a couple months and now he's looking for the whole year. So what does that mean? If the inflation, we know this, we know. So why the market is expecting 3 cuts this year if I've just give you the answer just now. Pay attention, guys. Okay. Again, he say that his confidence in inflation falling back is lower than before. Okay, first. Second, he say that his expectations that we will see inflation fall back this year. So this year, all right, this year. Now he was looking for a couple months. Now he's looking for the whole year. So what does that mean? Second thing here, what did we just looked at? we've just looked at that the Fed is looking for dual mandate, bring inflation down while having higher employment. Third thing, if the market is expecting, I don't know, 7 cuts or something like that, why? If he knows already that inflation won't be coming back down, so he won't cut the rates. He won't. While ECB, S&B, all the central banks will probably cut the rate, as S&B did already. But ECB will probably cut the rate sooner than the Fed. And one of Guindo's say that. Guindo's mentioned that if we need to cut before the Fed, this is it. We will. We need to do what it's supposed to be done. And that's it. So what does that make? That makes a good trade on euro dollar. Okay, that makes a good trade on euro dollar. Any questions on that? No? Let me see what else he said. Yeah, he said some atrocities here. So next thing he said was, it seems there are significant delays when lower rents will show up in that data. So he's expecting the rent on the US to continue to be higher. He also mentioned that inflation is falling below 3%. The Fed's employment target comes back into focus. So now they're looking because inflation came back to the below 3%. Now they're looking to work on the employment. Okay. He said that I'm not sure if inflation will fall enough or not fall enough to warrant rate cuts. Again, I'm telling you, okay. Paul said as well, I also don't have great confidence about whether there will be rate cuts this year. Again, okay. I'm just like putting the facts here. He also said that I don't see stagflation in terms of growth or inflation. That's all right. He also said that I really don't understand where their talk of stagflation scenario is coming from based on US data. Well, they have to say that because you know what happens. Let me just delete this one. I have my terminal here, so I'm looking on my screen. Okay, guys. So he said that if wage increases outpace productivity, there will be inflationary pressures. What I've just mentioned in the beginning of the conversation, people getting paid more, it's fantastically good, but it's not good for the inflation because then they will continue to spend more because they have more money. And this will generate more inflation. Easy as that. All right. A 5-year-old kid can know this. Okay. Next, he also said that imminent election will not influence rate decisions. So whoever wins, it can be Trump, it can be Biden, it can be Joseph, it can be Peter, it can be me, it can be you. It doesn't matter. The central bank, it's a completely different thing. It's a completely organism, completely disattached from the politics. All right. So just Jesus Christ. Is it that hard? Whoa. Sorry. Anyways, so these are all the big highlights from the FOMC that we had today. And now let's go look at some charts. There are someone trying to join us, but it feels like that the person can't join it. I've tried to accept it 7 times already. Let's go for here. Okay. Now, I want you guys to answer, and I'm not gonna go ahead if you guys don't answer this question. I want to know from you. Please write it down. I know it can be a tricky question. Why did this move happen? Right? I have been teaching you guys for a long time already. Okay? I just want to know, why did this move up happen? No one have a question. No one has an answer. No one. Okay. Right. All right. So if you have watched my video from the YouTube today, you probably know the answer why it went up and not down. But the answer is pretty simple. Okay. We don't have time to watch it, so I'm not gonna. We only have more 8 minutes. But the answer is because John Paul, when he was giving his speech, after there is some questions, and someone, I can't remember the name, asked him, one of the reporters, the journalist asked him, will we have another rate hike this year? And he said, no, we won't. Okay, so he sat down. So we're not expecting a rate hike this year anymore. And the market took these as, this is a big news. We're not going to hike anymore. So all the small little probability that we would have of a hike, it's gone. All right. So this is why, okay, there we go. So this is why we have this move up. Second, why the market is reacting negatively now? Well, because he's looking to it and he's like, okay, so it's actually hawkish. Right, it's actually hawkish. So then market is reacting to it. All right. Third point. I'm more than 90% sure, this is my own belief, all right, that the market is 100% waiting for the NFP. All right. That was funny because I say 90 and then I say 100. Yeah. Anyways, so the market is most probably waiting for the NFP. Okay. Because this is what we need to know. Jerome Powell have said so many things about unemployment, employment, average hourly earnings, have say lots and lots of things. We need to know what's actually happening so then we can take some trades. This is what the big investors are thinking. All right, this is what the big pension funds are thinking. Oh, well, we do have a big balance sheet to move to Europe, but let's see first what the employment will come so then we can take a better price or we can take a lower price, whatever. And then we move the money. So for my opinion, now is the NFP. All right. Any questions on that, or can I move to the next topic? No questions? Okay. So the next and last topic I have is the NFP. All right. I was talking to Peter Pan. You guys probably know him. I've done a podcast already. Oh, guys, please, as everyone is here, do you have any questions about gold? Gold or any other commodities? Please put in the chat because tomorrow I will have a meeting, or we have a podcast with please WL Whip, please give me Yes.
Sorry for your communication. I was somewhere, that's why I couldn't talk more about the area.
Sorry.
I said I was somewhere, that's why I couldn't talk when you asked
Oh,
about the question.
oh, okay. No, I was just asking if anyone has questions about gold, because tomorrow I'm gonna have a podcast with one of my colleague friends from London, and he's a fund manager.
Uh,
And oh, sorry, not a fund manager. Sorry. He's from Canada, not London. I'm confusing people here. So he lives in Canada, and he's a gold trader. He has access to Bloomberg and everything, so he's gonna be showing around us. So if you have questions for gold, then put in the chat now. If you have questions for gold, leave the questions on the chat that I will take a screenshot. So if you have any questions, anyone here for gold, put in the chat. I will ask him tomorrow the exactly same words. I will ask him, and then it will be published on YouTube on Monday, and you guys can have access to it. And I will send on the Telegram, and your answers will be and your questions will be answered. Okay. Now, Sweetie is asking about Aussie CHF. Man, you really like that, doesn't you? Damn. Yeah, I've mentioned this drop. What's going on here? Okay. I've mentioned this drop already, and it happened to here. This one, it actually came lower. It came to this one. But right now, man, I don't trade these. I would prefer to trade on the long side because it's following the trend, and just because the S&B have cut at the rates. So just between Australia, so just between RBA and S&B, still preferable to hold long positions on Aussie CHF. This is my personal opinion. Okay, you need to go, you do your own analysis, but from my understanding, that would be it. Okay. Euro JPY, I'm not touching JPY pairs except for USD JPY. So these dip that we all had on all the JPY pairs, it's good to continue to long them because they are good carry trades. So USD JPY is good carry trades and so on. Nathan Braid sent me a message. I'm scared to open this on live. Can I open, Nathan? All right. Oh, there you go. The data just came out for CHF saying 0.3. Wow, that's actually higher, much higher. 0.1 to 0.3 for the CHF, and the retail sales came lower. Okay. Yeah, it's costing more than what they're selling. That's pretty interesting. So that doesn't make any sense here, to be honest. All right. Okay, guys. Anyone have any more questions?
in Santos, I just have a question on Euro. That's that's my base. Trading. That's why I want to ask a question.
Sorry, can you write? I can't hear you properly. It feels a little bit
Oh,
noisy.
can you hear me? Can you hear me now?
I can hear you, yes.
Yeah. I said, for me, I really trade Euro USD and GBP
Oh,
USD.
euro dollar.
Yes. Yeah. So I just want to have more, clarification on
Look,
Euro
yeah.
dollar.
So I think euro dollar, it's one of the things here. I guess we will need. So you're saying it's too good to buy USD JPY. I'm not saying that it's too good to buy. I'm not saying for you to buy it. I'm saying that yes, in my perspective, in my own arguments, I'm looking to consider long positions on USD JPY because the intervention it gets absorbed by every time. Okay. So but it depends on your strategy, your risk management, and so on. Now, talking about euro dollar, I'm expecting euro dollar to continue to fall. But the primary thing is that I will wait until the NFP comes out, because it's a little bit not sure what's going to happen with the NFP this Friday. So I'm going to wait it to come down and trade next week. I think it will come higher, but the big thing is the unemployment hours, on the average hourly earnings and the unemployment rate. So all of those three come higher, euro dollar go 1.050 very quick. If it doesn't, then we'll get there, but it will get slowly and slowly, okay? And if we do have any other Fed speech by next week, we will need to pay attention on that. All right, guys, I hope I helped. Have everyone a good weekend ahead. Tomorrow I will be looking to talk with my friend, with my colleague, and ask him the questions you guys asked here. So basically, gold will be good. The upside and downside at this unstable time. So is it going upside? Is it going downside? What are the targets? Okay, I got you that. And so on. All right, guys. I see you next week. Have all a great weekend. Have, rest a bit. And we talk tomorrow. We talk next week. See you, everyone. Bye-bye.